Hello, my class. Hope you are doing alrighty. This is the second video for Monday. I'm going to try to keep it short, but the content is super important. This is about understanding profit and different kinds of profit. And these definitions become significant to understand for the most part, just because we're going to make a general claim here that economists think really differently than accountants, and the way that economists think about profit is a little bit unique. You have a sense of this already from understanding a little bit about opportunity costs, so we'll kind of connect to that concept a little bit from the beginning of the year. So a little bit of what we're going to be addressing in this short video will be implicit versus explicit costs. Okay, so unlike the cost curves that we've been looking at, these are more definitional, just understanding that economists are very interested in implicit versus explicit costs. We're going to be talking about accounting profit versus economic profit. So we're talking about profit, we're also talking about costs. We're also going to define a term called normal profit that is very important to understand. And we'll define profit first. So first of all, the most important thing is profit is always going to be equal to total revenue minus total costs. And if you think of yourselves as having a lemonade stand, and let's kind of imagine an example, Sarah decides to create a lemonade stand and maybe to sell each cup of lemonade for about $1, and maybe Sarah sells 20 lemonades this morning. That means her revenue is going to be $20 because each cup sold for a price of $1, and 20 cups were sold, and so $20 were collected. Total revenue is what you have at the end of a bake sale after you've sold all of your pizza. Total revenue is what a firm has after they have sold a certain quantity of a good for a certain price, okay? And oftentimes in various word problems, you will either be given information like the price and the quantity sold, or you'll be given straight up the total revenue. Profit is, of course, not the same thing as revenue, because revenue then needs to be, we need to subtract costs from revenue. So total revenue minus total costs gives you your profit. If your profit is a negative number, we call that negative profit or a loss, okay? So that's basically the idea. Economists do use the symbol of pi to represent profit. So if you see pi, equals TR minus TC, that's what we're talking about, okay? Pi is always equal to, or profit is equal to total revenue minus total cost. That's oftentimes the way you'll see this. And as always, total revenue equals the price paid times the number sold. And firms, of course, are interested in increasing their revenues and reducing their costs, okay? Total revenue is always price times quantity. Implicit versus explicit costs. This is important because economists are really interested in both of these kinds of costs, but they are different, and you'll be asked to define these on quizzes and on the AP exam. One way to think of an explicit cost is a cost that you actually have to lay out money for, the way we would think of a bill. So say that I'm a firm and I'm a bakery, or I'm that lemonade stand. I know that I need to buy lemons, I need to buy sugar, I need to have water, I need to have a variety of things that I might need to pay for explicitly. I'm going to give money to A&P, they're going to give me those goods. That is money exchanged, and that is an explicit cost. If I'm a bakery, I might have to pay rent. I might have to pay certain bills for using electricity, right? That's an explicit cost. At the end of the month, all of those checks that get sent to different services that help me out as a business, those are explicit costs. Implicit costs do not require an outlay of money, okay? It is measured by the value in dollars terms of the benefits that are foregone. Implicit costs, in other words, are opportunity costs. And we assume that we can calculate these. Certainly we know that sometimes an implicit cost might be something like your time, the time that you spend at a bake sale for an hour after school or missing period 9. That's an implicit cost. we assume that you can quantify that cost, okay? And of course, you're going to be given word problems where you'll be able to quantify implicit costs. In reality, some implicit costs are not really quantifiable, but we're interested in things that you have to give up in order to take an opportunity. Those are implicit costs, and the bottom line is economists care about them. So what it costs you to have a bake sale or a lemonade stand is not only the cost of the lemons and the water and the sugar and the things that are very explicit costs that you literally go and shell out money for. There's also implicit costs, right? And there can be any number of implicit costs. Businesses can often face implicit costs. One example of this is if you're using your capital, your factory or your machinery or whichever, your capital resources you have, you could have put those to use in some other way. If I'm a business and I am using my laptop to do some sort of consulting task, if I no longer do that consulting task, I could use my laptops for some other money-making type of enterprise. So implicit costs are when you're using your equipment a certain way, you are giving up the opportunity to use that equipment some other way, okay? And it's the same thing with land or other kinds of resources. Of course, the owner as a laborer or as an entrepreneur also is devoting time and energy to a business. If you take on an opportunity to start a business, you might be foregoing an opportunity to do something else. And that's a benefit that gets foregone and has to be included in the cost of taking an opportunity. Okay, so economists are interested in implicit as well as explicit costs. Accountants really only care about explicit costs. Okay, so that's going to be a key difference. Accounting versus economic profit. Okay, accounting costs are only those explicit costs, the things that you actually spend money on, not your time or anything like that. When we describe accounting profit, we're talking about total revenue minus explicit costs. So if you made, $1,000 revenue at a lemonade stand, right? And you had explicit costs of however much money for the lemons, however much money for the water, however much money for the cups, however much money for the ice, all those particular things. An accountant will tell you at the end of your lemonade stand, this is how much you have made in profit, just simply your total revenue minus your explicit costs. And that's essentially the accounting profit. On the other hand, economic costs always include implicit costs. Economists also count explicit costs. It's not that economists don't care about explicit costs. They definitely care about explicit costs, but they also add in opportunity or implicit costs. And so because they do, economic costs are always higher than accounting costs. There will always be implicit costs, and economic costs are always higher, making profits from an economic standpoint always lower than accounting profits. Economic profit will be total revenue minus total costs, which is really the same thing as saying total revenue minus explicit costs, which is your accounting profit, but also minus your implicit costs. Okay, so economists take out everything, whatever is left is your economic profit. So when we say in economics that a firm is making profit, that firm is covering all of their explicit costs and also covering all of their implicit costs, the cost of their time and any other foregone opportunities that they could have done with their capital, their labor, or their land. Okay, so that's the idea. So profit for an economist is total revenue minus total costs, which includes explicit plus implicit. Another way to say this would be economic profit is accounting profit minus implicit costs. Okay. This idea of normal profit. Normal profit means zero economic profit. Okay. And this sounds so sad if we said, listen, Innocent is going to run, a bake sale. And at the end of the time, Innocent has zero economic profits. We'd say to ourselves, oh, that's, too bad. It sounds like not really a profitable enterprise. An accountant might feel that way about zero accounting profit, but an economist would give a total thumbs up to Innocent and his economic profits of zero. Normal profit basically suggests that you have covered all of your explicit and your implicit costs, which means that you do have a positive accounting profit. So Innocent walks away from the bake sale with money for the club, but the accounting profit is not the same as the economic profit. We would also assume that zero economic profit means every single implicit cost is also covered, including Innocent's time, any other opportunity that Innocent or resources could have had other than that bake sale. So economists look at zero economic profit as actually pretty favorable. Even better would be a positive economic profit greater than zero. A negative economic profit means that you are not covering all of your explicit and implicit costs, okay? A normal profit means all costs are covered by revenues. That includes implicit costs, so that's favorable. When a firm is earning a normal profit, and this is a term that we use, normal profit means literally zero economic profit, it can do no better using resources in the next best alternative use. It's covering every single opportunity cost, so there is no better use of resources. So zero economic profit is the best a firm can do, okay? This suggests a little bit of a guide to see economic profit and how it is connected. If you imagine total revenue, okay, here's total revenue. So let's say that total revenue of $1,000. If you took out all of your explicit costs, cost for lemonade, cost for cups, all of that, and the cost of your time and whichever, what would be left would be your economic profit, okay? In an accounting, sense, right, which is different than economics, an accounting profit only takes out explicit costs. Accountants are not interested in implicit costs. They're only looking at dollars and cents. Economists are very interested in implicit costs. It makes business and costs a lot higher, okay? And that's something to keep in mind. Let's look at an example, and this is one that you can try. Debbie was earning $100,000 a year working as a scientist. And look at the was, okay? She was doing this in the past. She was earning $100,000 a year working as a scientist for a drug company. She decided to start her own business that conducted drug trials. She estimates this entrepreneurial talent, or foregone, that is a key word, tells us, it screams implicit costs, foregone entrepreneurial income to be $10,000 a year. She used $500,000 in savings that earned 5% interest annually to finance the new business. In the first year, the firm earned revenue of $1,500,000. The cost for rent, supplies, and employee salaries were $1,100,000. What's the accounting profit and what was the economic profit or loss? Okay, a negative economic profit would be called a loss. So there's a couple things I want to do whenever I get a problem like this that asks about economic profit or economic profit, accounting profit or economic profit. I could also be asked to quantify the costs, accounting costs and economic costs. So I always want to think of things in categories. The first thing I want to look for here, I know that profits are going to be revenue minus cost. So the first thing I want to find in this is what's the revenue, okay? And I am told the revenue. I don't have to quantify it here. I don't have to figure out how much the firm sold and what the price was. I am told that the revenue was $1,500,000. Okay, so we're looking to subtract some costs from this revenue to find out what's going on with profit. I also know I'm looking to deal with multiple kinds of costs. Okay, one would be explicit costs. Let's figure out the explicit costs first. Sometimes I have to look for these. In this case, I am given the explicit costs: rent, supplies, and employee salaries. Okay, these are explicit costs. The employer, Debbie, actually has to pay these. She has to pay her rent, to pay for supplies, and pay employee salaries. And so we know that explicit costs are $1,100,000. So that tells us that she's got an accounting profit of $400,000. Okay, if that was the only question we had, what was the revenue, what was the explicit costs, what's her profit, we would be in business and it would be $400,000. Economists say, whoa, wait a minute. There are some costs that Debbie foregoes. She gives up certain things to actually open this business. Okay. Those things that are foregone, that is the opportunity cost, otherwise known as implicit costs. Okay. So the implicit costs will be several in this case, and I'm going to flip to the next slide to show you this, because I do recommend just putting this on a piece of paper in 2 columns. On the very left, I have the explicit costs, and I just took that right out of the problem, right? 1,100,000 for rent, supplies, employee salaries. Very straightforward. I would look for any costs where Debbie had to pay actual money in order to pay those costs. The implicit costs are a little bit trickier. One implicit cost, and I had to actually quantify these, so I had to pick them out of the problem and quantify them. One cost is $100,000 of a salary foregone. We're told that she had a salary of 100 grand. When she takes this business opportunity, she's no longer going to work full time. She's going to work for her new business. And so she used to make $100,000. That's a cost, right? If she's not going to make that much at her new business, an economist would say, don't do this. This is a bad idea. Okay. So, implicit costs help you make decisions about a new opportunity. So Debbie says, okay, $100,000, that's part of my implicit costs. Another cost, which is different than her salary, is entrepreneurial income foregone, and that is spelled out in the problem. Maybe she consults for other firms and she would earn about $10,000 doing that. That's money that she's also going to give up or forego because she's opening her own business. So she's kind of out $110,000 so far. We also know from the word problem that she has $500,000 in savings. She's going to move that $500,000 into her business. That is actually not a cost at all because she's just moving money. It's a wash, okay? $500,000 is going from one account to a new account. She still has use of that $500,000. What is foregone is the interest that she would earn on that money. So anytime somebody has money in a savings account or some type of an account where they're earning interest on it, and now all of a sudden they rip that money out and they're going to use it for some other purpose, they're no longer earning income on that money. So she foregoes an additional $25,000. And that is going to be, if we total all of those up, so it's $135,000, those are her implicit costs. So when I figure out on the right, what is my accounting profit, which is revenue minus explicit costs, she has $400,000 of accounting profit. So the accountant says, you should totally do this business. It's a great idea, really good idea. The economist says, wait a minute, we have more costs. Your profit really isn't that high because you're giving up some things. So the economist says revenue minus explicit costs, which gives me the 400,000, also minus implicit costs. And when I subtract the implicit costs, I'm left with a positive economic profit of $265,000. So an economist would say you should totally do this new business, even though you're giving up 100 grand of a salary, $10,000 of income foregone from entrepreneurial consulting, and you're giving up interest income. You're still going to be doing better by doing this particular business, right? In fact, you're going to be doing $265,000 better. So you should totally do this. If it was zero economic profit, an economist would still say, do it. You've covered all of your implicit costs. You've covered, it's kind of like a wash for you, which opportunity you do, but we kind of assume you want to do the business. So go for it. If it's a negative economic profit, say this was negative $265,000, then we say, don't do it. You're not better off doing this business, stick with your day job, at the drug company. Okay. So I am going to leave a series of a few problems for you to practice. Please submit them to Schoology so I can see your work. And then tomorrow we'll kind of continue with some additional work on this kind of topic and on marginal benefit and marginal cost. And by Thursday, we'll be getting to our first market perfect competition. Okay, be well. I'll see you soon.